your own research and always seek individualized expert advice for your specific situation. Attorneys, accountants, investment professionals, any other professional services. Okay, great. So we have myself as one of the leaders and Rick is the other leader. I'm a real estate broker, property manager, investor. I've also done some note lending. Landlord, we have our business both in Virginia. We have our main real estate brokerage in Virginia where we manage about 120 properties now. And I do short, mid, and long-term rentals. And then in Florida, it's mainly our own investment properties where we have some short-term rentals down there. And actually, we do have some long-term too, where we rent out by the room. So we do some house hacking in different ways. That was actually how we got started. So Rick, did you want to add anything?
Yeah, just one thing. And I'm sorry I had to turn my video off. I have very weak signal. It's 5G, but it's very weak. So one of the things that I've been working on and lately and hearing more discussions about is, I don't know if you guys listen to a podcast. It's called the New Home Insights podcast. It's by John Burns. And he has a guy by the name of Dean Worley. And Dean interviewed this builder about ADUs. And there's been a lot more talk lately about ADUs in the marketplace. Namely, Fredericksburg is having discussions about it. The city of Fredericksburg is now entertaining ADUs, and there's, they've already approved it in the state of California has approved ADUs statewide, and I believe the state of Washington has also done some aggressive things in Seattle with relates to ADUs. Usually places like I call them the Democratic states, the Californias, the Massachusetts, they are the very populated states. They usually are very proactive. The whole idea is to bring more inventory to homes, more inventory and which will hopefully stabilize prices. I just found it very interesting that now Fredericksburg is sleepy Fredericksburg is talking about ADUs. And again, I don't know if you guys caught that, but if you Google Fredericksburg and ADUs, you'll probably see some links that might be something you should at least look into. And I know I just want to throw that out as it's something that is, we try to do with mother-in-law suites and converting a basement to a second unit kind of thing. But it's now getting some traction with the big boys, which is good. So, but that's what I'm listening to and working on and hearing more about. Thank you.
Awesome. Definitely. I did see that legislation going, so that is good. Okay, so we are a member of National REIA. So if you would like to be a member of National REIA and also get the recordings, it's $70 a year for all the National REIA benefits, and you can contact us. Either email, call, or text, and we'll be able to help you out with that. Tonight, we do have Rick Thompson. Next month, we do have Rich Lennon, and that will be on the 15th of June. Brent Bowers is going to be on the 13th of July, and then we already have another speaker for August too. But if you know of someone that we'd like to have for September and beyond, let me know. All right, we already did the introductions. Does anyone have any needs and wants? Or a property pitch? All right. We're going to go to the statistics real quick. So we want to hear what Rick Thompson has to say. So Rick Banez, go ahead.
Okay, so we're going to turn our attention to Fredericksburg and Virginia right now, and then I'm going to turn the cards to Florida. So a couple things that have changed a little bit, and going from March to April. This is April data that just came out on 2 days ago for us. You can see that the number of new listings has actually started to go up. So we're starting to get that summer spring selling season kind of kicking off. So a little bit more new listings, which is a great thing. You can also see the new pendings are up significantly, and closed sales are down. But closed sales are down because there's not enough inventory. That's my opinion. I just feel like there's closed sales. If there was inventory, it would be selling, and that's what's propping up sales prices. So if you look at the chart below where it says the median sold price is 435, it actually went up $15,000 from last month, 3.6%. And you can see from the purple line, how it's slowly increasing. And again, you read the stats in the news and things like that, and you hear things. In Fredericksburg, it's a totally different tale. Prices aren't coming down yet. If anything, they're going up, and so it's a function of inventory, and so I believe that's why prices are going up. And even though there's more listings coming down or coming into the marketplace, there's still not enough inventory to handle the buyers. So anyway, let's go to the next slide, and we can kind of see what's happening with the days on market.
That too, and just highlight. I mean, realistically, new listings are down almost 40%. That's huge from last year.
Yeah, I see what you're saying.
Why the prices aren't going down.
Good point. All right. So now if you look at the active listings, days on market, you can see we're on the and you can see the 5-year average was 964. So there's not a lot of active listings. Going back to Anna's point, not inventory. The days on market, it's creeping up. So we were experiencing 14 a year ago. Now we're up to 27 days on market. So the homes that are going on the market, they're taking longer to sell. But prices, sellers are getting the price. They're only having to come down 0.1%. So prices are standing firm. So if we look at that and we compare what's happening in Virginia, at least Fredericksburg, and every market's local, let's look at the next slide and talk about Florida. And I've changed the data around on this. I know it's going to be a little bit hard to see, but I wanted to kind of just point out some trends here. So what you're looking at is a little bit different. This is the Fort Lauderdale, Miami, West Palm MSA. So this is a big area, a major market area. And what you'll see here, and I'm just going to highlight a couple of things because I know it's very difficult to see, but I wanted you to see kind of if you look at the chart on the right-hand side, it can kind of give you the overall trend of what's been happening long-term. But if you look at the number of closed sales, it's down 15%. Okay. That's pretty low. And if you compare that to cash sales, it's down 27%. The median sold price is only up 5.6%. So prices are actually going up when it comes to the median sold price, but the average sales price is down minus 7%. So a negative 7%. The dollar volume is down, again, tied to inventory, I believe, but also interest rates is down negative 21%.
So if you ask my question or opinion, I think the reason that compared to the median sales price and the average sales price, I think the reason that the average sales price is down 7.2% is because the high-end properties are dropping. That's my opinion on that.
It could be. Let's go to the next slide and the last for the data. Okay. Then the last slide here talks a little bit about new pending sales and new listings. And you can see two big negative numbers. New pending sales is down negative 17%. New listings are down a negative 19%. Pending inventory is down 22%. And active inventory is at 78%. So the month of supply has increased actually quite a bit to 138%. And this is just for single family homes. I haven't the data combined to include condos because condos are a bigger part of the market in that major city. And the numbers are even more dramatic. I chose just single family because that's what really Fredericksburg is mostly. But I wanted you to see kind of the differences in the markets and what we're going with. You might have heard some of these podcasters talk about cyclical markets. And definitely I could see this being the case. Hot and cold markets, where it's where Fredericksburg is definitely just steady Eddie as she goes. And it's a totally different market than the South Florida market is. So anyway, I hope this information helps, or at least provides some insight in terms of the differences you see between the markets. And I'll tell you, it gets even more interesting if you go by city. Like you start to go down to Fort Lauderdale level, or you start to go down to Wilton Manor, or you get to these even individual towns in a certain county. And it's amazing some of the differences you'll see.
Definitely. I mean, it's different from Virginia. It's different from the Gulf side. You know, we own properties on the Gulf side too, and it's different here. So imagine Virginia, like you have, you know, Stafford and Spotsylvania and Fredericksburg and all of this, right? Well, these are kind of miles away, where in the Fort Lauderdale, Miami area, you've got these areas, Wilton Manors, Coral Ridge, you know, these different areas, and they're like a mile, 2 miles, a couple blocks, you know, that type of thing. And they're just so drastically different. They're almost like counties in Virginia. And on the Gulf side, it's the larger areas also. You know, you've got Inglewood, and then you might have the beach, or you might have Northport or whatever, but they're further away. Whereas, you know, in Fort Lauderdale, this area, Miami, there's so much more, it's so much more closer together and dense, and it's so changing just like a block. So it's very interesting how the market works. I wish we had, normally we have somebody from the Miami, Fort Lauderdale area on the call too. So we don't tonight, but it's very interesting if they were there to explain. All right, Rick T, are you ready? The man of the hour, 2 hours. The 2 hours. So, all right, Rick Thompson, he is a fellow investor and member here, and he is going to let us know about private lending tonight. So he has invested in single family, multifamily syndications, and also does private lending. He was focusing on New York for a while, and I think you've sold all those, right?
Almost.
Almost. And so now I think you mostly focus on private lending, right?
That's correct.
He is going to share his wisdom with us tonight, and we are very excited. Thank you so much. Would you like to share your screen?
Yep, I'm going to do that.
Isn't he Uncle Pennybanks on Monopoly? Isn't Rich Thompson the role model? You know, that rich Uncle Pennybanks in Monopoly.
Monopoly guy.
Yeah, he's a Monopoly guy.
We play Monopoly all the time. A real life Monopoly is what we say. All right.
We do.
Rick T, take it over.
We love collecting $200.
Can you guys see my screen, Anna? Is it up?
Yes.
Yes, we can.
All right, awesome. Well, real quickly, thank you for having me tonight. It's been a whirlwind of a week. I just got back from Dealmaker as well, and several of the folks on the call obviously were there, and it was great to see everybody there. You know, trying to get ready for tonight and speaking, and then spent most of the day today wrapping up some loans, and some people even on this call I was speaking with today. So it's been a busy day. A little bit about myself. I've been investing now in real estate for probably close to 10 years. I started off as a buy and hold investor, and I built a small portfolio of about 18 rentals using the BRRRR method. And I did that by using a private lender. And as I was going through that process, the light bulb clicked with me at one point when I saw the private lender getting paid off after every time I would refinance. And I thought, wow, that private lender's, you know, making a nice return on their money, and they're not swinging a hammer, they're not hanging drywall, they're not dealing with city permits and ordinances and everything else. And so I put that in the back of my head, and I thought to myself, well, someday I wouldn't mind getting to that point in my career where I could become a private lender. And over time, I started, you know, somebody mentioned it on the call earlier, there's so many things in the real estate investing world that you can do, or you can, you know, there's so many shiny objects to chase. And I think people need to really figure out what it is they want to do and do it well. And private lending is my niche. It's what I love to do. And I've been doing it now for about 4.5 years. And it took me a while to get started, like to get very busy doing it, because I wasn't really sure how to build that market, and I wanted to start slow. And that's what I did. I started selling off my portfolios and sort of moving my assets to allow me to capitalize, to be able to become a private lender. I started networking with different people within the real estate world who understood private lending and started teaching me how to do it. And it was really relationship based, as everything is in the real estate world. And I think that every day, you know, our relationships are what make us successful here. So that's what I've done. I've moved away from my single family homes and my multifamily that I owned, and I moved more into syndication type deals. I've invested in wedding resorts. I've invested in large multifamily syndications, large land deals, 2,000 plus acre land deals. And that's allowed me also to build capital over time. And now all I do is focus on lending. I've got 3 single family homes left that I'm selling currently. They are almost under contract in a portfolio, and those will be the last of my buy and hold properties. And I still look. I went and walked a property last week here in Fredericksburg that I was interested in looking at. And if the right property comes along, I'll be interested in buying it if it's the right property at the right price. But right now, I just like to focus on lending. So I wasn't really sure what to put together tonight. It's not easy to teach somebody to be a private lender. So I don't think that's my goal tonight. I think my goal tonight is to try to help people understand what private lenders do and how we do it. And then if you ever want to work with a private lender, if you're interested in scaling your business or flipping homes or buying and do a refinance out, like a Burr type deal, you're going to need a private lender most likely. So I kind of wanted to explain what a private lender does and how to best develop that relationship so you can move forward and move down that road. So hopefully that'll set the stage. I don't like speaking a lot, so please, if there's any questions, either just unmute and yell at me or put it in the chat box. And Anna, if you can see if there's questions in there, just stop me at some time and ask me the question. I'd rather this be a little more of a conversation, but it's tough to do on Zoom. So I'll start going through the slides here, but if anybody wants to stop me at all, just stop and yell at me and ask me a question. Okay. So with that, I'm going to give you my disclaimer right now. So I am not a certified public accountant. So nothing I tell you tonight, you should be taking as, professional guidance to do with your taxes or your accounting or anything else. I'm not a certified financial planner. Although I love personal finance, I love trying to help people grow their wealth and leave a legacy for their family and those sort of things. I think I have got a pretty decent grasp on personal finance and tax strategies and those sort of things. However, nothing that I say tonight is considered financial advice. I'm not an attorney, and the presentation tonight is for educational purposes only. None of what I say tonight constitute financial, investment, and or legal advice. All right. And I just did want to say that, it was really good to see a lot of people on here at Dealmaker this time. I remember the first time I went to Dealmaker, Rick and Anna, you guys may have been there the first time. I can't remember, but there was like 3 of us from Fredericksburg. This time we had literally a Fredericksburg mafia there. We had
nice.
I think we had 15 probably from Fredericksburg or 20 people there. So it was great. We had a really good crew show up. So just wanted to thank everybody for going. Okay, let's get started. The golden rule of private lending. The golden rule of private lending is he or she who has the money makes the rules, right? And when you hear that, it comes across as like a callous statement or, egotistical or something like that. And it's not meant to be that way. What I mean by that, or when I hear that, what I think it means is that every private lender is different. Everybody does things differently. Chuck is on the call tonight. He's a lender. And Chuck and I, we know each other very well and we share deals and we do those things, but Chuck and I do things differently, right? And every private lender out there is going to do something different. So whatever I say tonight, is based on how I do business. And I asked Chuck to be on tonight because I wanted him to fill in some gaps for me. So if I say something that's, way off, I wanted Chuck to interject and say, well, I do things this way, right? And as we go through this, I think you'll see where I'll point out I do it this way and others do it this way. So I think what's important is if you ever want to engage with a private lender, get to know how they do their business, right? And if you are not comfortable with the way they do their business, go talk to another private lender and ask them, how do you do your business, right? And not everybody's a fit for everybody. So figure out the private lender that fits with you and is going to help you move your business forward. That's sort of what this slide is for. All right, so I want to go over my goals as a private lender. So every day, this is what I focus on. I try to create win-win scenarios and build lasting relationships with real estate investors and developers. That is my goal. Every time I lend money to somebody, I want to lend money to them as many times as they want to borrow money from me. So I don't want to do a one deal and never see them again. We are trying to build a lasting relationship. There's people on this call tonight who is, has worked with me for years, who has wanted to borrow money or has borrowed money from me. And we will continue to work together, hopefully for years to come. So that's my goal, is to create a lasting relationship in win-win scenarios. The other thing I want to do is I want to help investors overcome their biggest obstacle. Chuck said it early on when he was introducing himself. I think he said, hey, I help investors move forward by providing capital, right? That, as an investor, when I was first buying buy and hold properties or BRRRR type properties, I didn't know where I was going to get all the money. I really didn't. The first deal I did, I used my own capital, and it wiped out a lot of my money to buy that property in cash. And that, when I did the BRRRR and I went and refinanced out and I got all the money back, I thought, wow, why did I use my own money? I could have used a private lender and just paid them off. So this is where, what I can do is I can bring capital and I can help solve that problem for most investors. Now, you'll see there, I got to move this. I think I can move this or not. I can. Trying to move my my camera pictures out of the way. Anyways, we're very conservative when we underwrite deals. When I lend, and you'll see this as we go through, I'm going to be in first lien position, right? So I'm going to be by deed of trust and a promissory note and personal guarantee. I'm going to be in first lien position in that mortgage, in that loan. Most of our loans are short-term loans. We don't like to lend. Typically, most of our loans are written at 6 months. If a borrower needs to borrow money longer than that, and they let us know up front, we can write a loan for 8 months, but we typically don't go over 8. And the reason why is we really want to keep our borrowers focused. If we have written loans before at 12 months, and sometimes when we do that, our borrowers start to lose focus. They want to get another deal going, and pretty soon they're cutting themselves short. And next thing you know, they've gone past maturity on a loan, and now they're paying late fees, or they're paying default interest or whatever. So we try to keep our borrowers very focused. We do short-term loans, typically 6 months. We can do a little bit longer, but that's what we do every day. And lastly here, this is super important. And I think unless you're an experienced investor, you probably aren't really going to understand what I'm going to say here, but we help investors really understand their numbers, and we protect them from bad deals. I can't tell you how many phone calls I do a week where not only do I tell an investor, no, we're not going to lend on that deal, I also say, you really need to think about this deal, and here's why, and show them where they're off on their numbers, show them where they're underestimating their rehab, or where they're underestimating holding costs, and those sort of things that they're just not understanding, because probably they don't have the experience. And just last week we had a deal that we wanted to do it. We really did. We liked the borrower a lot. We've been working with her for some time, and she came to us with a deal, and I think she just overpaid for it slightly. And the numbers just wouldn't work. And I sat down with her, we went and had coffee, and I said, look, we're not going to do this deal, and here's why. And, you know, she completely understood, and she thanked me for doing it, and she walked away from the deal at the end of the day. But that's the type of stuff that we try to do, is protect each other as well. All right, so once again, I'm approaching tonight as if I have borrowers out here on the call, or people who want to know how to initiate a relationship with a private lender. So I want to put some tips on here to talk to people. So number one, don't wait until the last minute to establish a relationship. Go to your local meetups, go to your, you know, try to network as much as you can, go to these conferences, try to figure out who the private lenders are, and go talk to them. Generally at most like meetups, it's probably the guy who's sitting in the back drinking a beer and trying to be quiet most of the time. And but don't wait until the last minute to develop that relationship. And you know, you'll hear the term private money lender, and you'll hear the term hard money lender, and everybody says, well, what's the difference? You know, and to me, the difference is hard money lenders are very institutional. They don't really care about a relationship with a person. All they care about is the asset, and does it underwrite, right? So if they can underwrite that asset and they can put money on it, they're probably going to. They don't care about the borrower. I care about the borrower. You hear the term like, do you bet on the horse or do you bet on the jockey, right? And I bet on both. I bet on both the horse, but I also really put a lot of weight on the jockey. So I want to have a relationship with somebody that's calling to ask for money. And so typically I like to know people, and I like to, you know, I do my due diligence. I go onto your Facebook page and I look at what you're doing. If you're doing things that aren't really moral and ethical and things like that, I'm probably not going to lend money to you. But I like, you know, people who are doing the right things. I like people who have an established business and can prove to me that they've got some experience. And I like people that take the time to come talk to me, or, you know, hey, let's go grab a beer, let's go grab a coffee and sit down and talk about private lending. So if you're looking for a private lender out there, just put yourself out, go to your meetups, introduce yourself to a private lender, talk to them about what their terms are, you know, how they do their deals, and just get to know them, and it'll help you in the long run. Don't wait until the last minute to secure funding. So I know Nate's on the call, and Nate knows that I got a call last Friday, not last Friday, 2 Fridays ago. I got a call probably at about 4 o'clock in the afternoon from a borrower who said, hey, my other lender just fell through. We're closing in 5 days. It's a $435,000 property. Can you help? And we made that loan happen. In about 3 days, we had money to the title company to make sure that that borrower was able to secure that property. So that's, you know, we can do that, but he's a very strong borrower. He's a very experienced investor in the area. He's got a lot of, you know, over 70 properties here. Like, it was not a hard decision to lend to this particular investor. But if I don't know you and you call me on a Friday and say, hey, I'm closing in 5 days, you know, I'll take a look at it and see what I can do. But most likely, if I don't know you and I don't know the property, it's going to be tough for me to make that loan in that amount of time. So as soon as you know that you're going to do a deal, try to get in touch with a private lender and try to get the ball moving. If you lack experience, find a partner with experience. This is the biggest thing. Probably we turn down 80% of our loan requests. So if you think about that, out of every 10 phone calls we get, 8 of them we're saying no to. Most of the ones that we say no to are because people don't have the experience to do the deal they're trying to do. And they don't have a partnership with anybody with that experience. They've never flipped a home before. They've got no rehab experience. They don't know their numbers. They don't understand holding costs, several of the things that we talked about before, yet they want to borrow private money and try to flip a home in a market like today. So if you don't have the experience and you know you don't have the experience, find a partner with that experience. Find somebody who can help you through it. And I've linked up several borrowers with experience in this area just to help them get through a project, or to back them on a loan, right? If we're going to lend money and I know that somebody's going to partner with this person, we'll be more apt to lend money on that deal. Understand a good deal and how to present it to your private lender. When you call a private lender, you should have all of these things laid out, right? And I think I even have this on another slide. Like, if you're going to call me and ask for a loan, I'm going to give you a list of all the things you need to bring to me in that phone call. But you should know what your purchase price is. You should know what your after repair value are, what your rehab is, all these sort of things. And if I ask you what the ARV is and you say, what does ARV stand for? I'm going to ask you now to go partner with somebody with experience, right? Because if you don't understand what that is, then you shouldn't be asking for private money. Let's see what else. Be professional and timely. So I'm going to do my part. If I'm going to fund a deal in 5 days or less, that is me working, 12-hour days at least to get this deal done. Writing documents, talking to a title company, doing all the due diligence we need to do, driving to the property to inspect it, all those sort of things that we're doing. And then I'm going to ask you for certain things. And oftentimes borrowers aren't timely, and we don't go to closing because the borrower couldn't get me the documents they need to get me. So we're ready to go. I gave you my word that I could close on time, but the borrower then fails to provide what they need, whether it's insurance or whether it's, copies of their operating agreement for their LLC or whatever that may be. So be professional and timely with your private lenders. And, if that happens, probably more than once with a private lender, that private lender probably just won't entertain a phone call with you anymore. So, they're busy people. They've got a lot of phone calls going on. They got a lot of paperwork and deals going on. So just try to respect their time. And when they ask for something, try to get it to them. Okay, here's the other slide I was going to share with you. So if you were to call me or any private lender, be prepared to deliver this basic sort of set of information to them, right? All right, let's go through this stuff. So number one, the property address, that's a no-brainer. Okay, we need to know, do you have the property under contract and what the purchase price is? All right, so with the property address, we can immediately start our due diligence, right? I can immediately start pulling things online, information. I can, if it's close enough, I can go drive to the property, whatever. I'm probably not going to do that yet. Right now, I'm just going to collect all this information from you. I'm going to look at your purchase price. I'm going to ask you what the after repair value is, and I'm going to ask you to provide me 3 comparables. And you're going to ask me, well, why do I need to provide you the 3 comparables? Because I want to understand how you came to your after repair value, right? Believe me, I'm gonna validate it, but I want to see what you believe your after repair value is, and that will also lead down the road of me understanding: are you experienced? Do you understand your market? Do you know where it's going? Because those who are at Dealmaker probably heard this too, that you're not flipping a home for tomorrow. You're flipping a home for 6 months from now. And the market can shift in 6 months very quickly. We all saw it happen over the last year, right? And we all saw it happen in 2008, and we all saw it happen in those days. So believe me, the market can be completely different in 6 months from today than it is today. So you need to understand your market. I'm going to ask you what the scope of the rehab is, what your budget is, what your exit strategy is. Are you trying to flip the property? Do you want to do a BRRRR on it? You want to do short-term rentals on this? What's your exit strategy? And I really hope that most of the professional investors that come to us, they have multiple exits. Like, if a flip's not going to work, they're going to BRRRR it. And if the BRRRR is not going to work, they're going to put in a medium-term rental, traveling nurses or whatever into the property. They've got multiple different exit strategies for their property. So think about that before you contact a private lender. Your business entity, we do not lend to owner occupied properties, right? I know that I think there's some mortgage origination officers on the call tonight. Those are the people you need to speak to if you need a mortgage for a owner occupied property. Most private lenders won't do it at all. So I lend to basically LLCs, right? Companies. That's who we lend to. We don't lend to people, we lend to businesses. So you need to have an LLC in place, and we'll want to know your operating agreement, your articles of organization, how you're structured. If you have partners, if you're a sole operator, we'll ask those questions. I'm going to ask you what your experience is, right? If you've got 5 flips under your belt and you have a couple buy and holds that you've been holding, you've got some experience, right? As I said before, a lot of the people that we deal with are doing 30 deals a year. They call nonstop. We know who they are. We've got existing relationships with them, so we're not so worried there. It's the new call, the brand new call. So be prepared to talk about what experience you have. And once again, if you don't have anybody, we're going to ask you to either bring somebody in, or we're probably not going to do the deal. You'll hear us talk about skin in the game. That is how much money are you willing to bring to the deal? I think people have this a little bit of a wrong idea that private lenders typically lend 100% of the purchase and 100% of the rehab. I certainly don't do that. Chuck, are you still on the call? Are you still here, Chuck? I don't know if he is. He may have left.
I'm here.
Okay.
I'm here.
Chuck, do you
I
do
saw him chime in.
I've done maybe 3 or 4 over the past. I've been a lender now for about 5 years. So I've done in 5 years, maybe 3 or 4 100% loans. And the reason I did those is similarly to what you were talking about a moment ago about someone who called you up, closing in 5 days, their lender fell out. So you knew the borrower and you were able to step up. If in the 3 cases that I've done it, the borrower was a return customer and had a great track record with me. I had loans out with them before, and their payments were always on time. Their payoff was ahead of schedule. They were solid investors. So, and plus they bought the property at a really good price, because if you buy it at a good enough price, let's say I'm going to loan 65% of your LTV. It could be, if they've bought the property at a good enough price, 65% of LTV might cover their purchase price and rehab. But as a rule, I don't make 100% loans, even if it's a good buy, especially if someone I haven't worked with very much or at all before.
Yeah, very good. And I totally agree with you, Chuck. I say that we do not do 100% loans, but there have been cases where with certain borrowers who have been our rock star borrowers, we know the type of work they do. We've had a relationship with them for years. There are times we've gone, really, really close to 100% of the purchase price. We always really want them to have some skin in the game a little bit, so we do ask them to bring something. They're definitely going to do all the closing costs and all that. But typically for a newer borrower, we are looking generally around 15 to 20% down payment on the purchase price. We'll bring the rest of the money for the purchase, and we'll bring 100% of the rehab money if it's a deal.
And I will say, Rick, that the 3 loans that I did do 100%, the points were higher. I mean, there is a little bit of a trade-off.
Yeah. Yep. Absolutely, Chuck. Thank you for that. So once again, if you haven't worked with a lender before, they're probably going to want you to have some skin in the game. Even if you go to a hard money lender, hard money lenders are going to want you to bring 20% down. We're not always at 20%. And like Chuck said, we're going to look at the deal. If you bought it right and the rehab numbers make sense, we're willing to work within those numbers and see as much as we can get you. So it just really depends on the deal, and you'll hear me say that later on as well. So based on all this information, like this is probably a 10 or 15-minute phone call with me. And then based on that, I'll quickly make a decision whether or not I'm going to move into like an underwriting phase and consider this deal. By the end of that phone call, I'm going to say either no, I'm not interested in this deal, or let me call you back tomorrow. And if I say, let me call you back tomorrow, it means I'm probably interested. I just need to underwrite a little bit. So the next thing I do, like once I get off the phone with you, here's what I'm going to do, right? I'm going to pull my own comps. Remember in the last slide, I asked you to bring 3 comps to me. And now I'm going to pull my own comps, and I'm going to reach out to the people I know to ask for comparables, and I'm going to compare, right? And the reason I'm doing this is because I want to see how conservatively you're thinking. And I want to understand that you pulled comps the same way I pulled comps, and that we both understand our market the same way. Because if you gave me a bunch of comps that said a property was $450,000 ARV, and I pulled a bunch of comps that said it was 420,000 ARV, we've got a little bit of a delta there, right? And I would much rather you come to me and say, hey, it's 420 ARV, and then you sell it for 450, than if you came to me and said it was 450 and you had to sell it for 420. So that's why I pull my own comps, and that's why I compare them to yours. I'm going to do my online research, right? I'm going to map the property. I'm going to go in and do some record looking into the courthouse and all that kind of stuff. If it's, within an hour and a half for me, I'm probably going to go drive it, and I'm going to go walk it and look at the property. And then I'm going to do a complete underwriting. And if it's something I'm going to do a loan on, I'm going to provide a loan commitment letter, right? And this generally comes in an email. It basically says, hey, we're willing to lend on this deal. Here's our terms and our rates. And we lay it all out to you. And then we basically give you 24 hours to accept that, because once again, we're busy and I'm not going to waste a lot of time on a deal. So you got 24 hours to respond to me and say, yep, let's move forward, or 24 hours to say, no, we don't want to move forward. And the only reason, again, I'm not putting anybody on the spot here. It's just, I need to know whether or not to move forward or not. So for the borrower, here's what we're looking for you to do. We need, to provide all the documents, the ratified purchase contract, all your LLC documents, your identification. If you have an LLC and you got 4 partners in that LLC, I need all the documents for all 4 partners. And I'm going to ask all 4 partners' spouses to sign a personal guarantee as well. So we're going to get into that a little bit. So when we do a loan, we do a deed of trust, we do a promissory note, we do a personal guarantee. If it's a 1-member LLC, it's pretty straightforward. If that 1 member in the LLC is married, we do ask the spouse to also sign a personal guarantee. Our borrower obtains builder's risk policy or landlord policy, depending on whether or not this is a flip or it's just a buy and hold, or if they're doing a BRRRR. We require you to have insurance in place before we close, right? And we provide the mortgagee clause to the title company, and then they provide that to you and help you get that onto your insurance policy. And basically, what a mortgagee clause, it basically just says that we're the loss payee or the additional assured on that policy. So if the property were to burn down, we're going to be made whole because of that, or that sort of incident. Our borrowers obtain professional termite wood inspection. Here in Virginia and, a lot of places, there's a lot of termites around. Chuck, I don't know how much you do down in the Petersburg area, but, termites love those older houses down there. So we always ask for like a termite inspection. And we get this report done before we close. Lender's title policy. This is something the title company does. But the borrower is responsible for paying for this at closing. These are really the big sort of things that we require at closing. We don't have any upfront fees on our loans. The way I lend, I don't have any upfront fees. If I commit to you that I'm going to provide you money, there will be money at the closing table. You don't owe me anything until the back end of a loan. I don't take any monthly payments for interest. And this is where I'm getting into, all lenders are different, right? And Chuck, you can speak up here if you do monthly interest payments, or if you do points or whatever. Like, I don't do points. I just do straight interest for the most part, although I'm looking at points now a little bit differently. I do straight interest, and I do everything on the back end. So once a flip is done and it's sold, that's when I get paid, and that's when I get paid my interest and my money back.
Rick, will you loan me some money?
Yeah. So
I do. I charge a monthly interest only payment because I want the a borrower to keep in mind they have a loan. So you mentioned it earlier that the reason for the shorter term loans is so it doesn't get swept back into the corner somewhere, that the borrower is aware of it. Well, that's why I charge monthly interest payments, just so it stays from month to month, it stays on the borrower's radar, especially if they have more than one deal going.
Yeah. You also mentioned you charge points. Is that right, Chuck?
Yeah, a couple. And that's good that you brought that up, because I did a loan here recently with 0% interest and 10 points. And it sounds like terrible. It's like 10% interest, right? The difference is the loan was like a bridge type loan. It was only for 2 months.
Right.
So if it's 10% interest, you're not going to make any money in 2 months' time. So it was the same. It was the same, if they keep it 2 months or 4 months or 6 months, it would be the same. But so it really depends on the deal. There's so many different ways to structure these kind of things. But the points are paid. When I do charge points, they are paid on the back end, not up front.
Okay. So once again, this is just what I'm saying about how lenders do things differently. Every lender, like you go talk to Chuck and he's going to have a different set of rules in the way he does business than the way I do business. So, and like Chuck said, every deal is different. We look at every deal independently. And, I don't know how many times people, when they learn I'm a private lender, the first thing out of their mouth is, what are your rates? And that's probably not the best thing to ask a private lender the first time you meet them, because you're telling a private lender you don't have any experience when you ask that question, because every private lender looks at every deal independently, and rates are typically based on risk, right? So when we look at how much risk we are putting into a deal, our rates are going to increase, right? And that risk, once again, is based on our borrower. It's based on the property. It's based on the market. It's based on, a ton of different things. So our rates can go up and down. And typically what you want to know is just, can I develop a relationship with a lender? Not necessarily what are your rates, because people come up and they ask that, and I just tell them it depends on the deal. You bring me a good deal and you'll get a better rate at the end of the day. So Chuck, do you have any comments on that?
Yeah, because if you ask what are your terms, I have seen a couple of incidences over the years where a lender might say 5%. and a couple of points. Well, who wouldn't jump on that? 5%? Are you kidding? When another lender is asking for 10%, 11%? What's not disclosed until after the fact is there are a ton of fees, administrative fees, monthly carrying fees. There was one lender, and I use the term lender loosely, pretender lenders, who actually charged after you finished the loan and you were ready to pay it off. Then you found out that the lender charges $250 to send you a letter with the payoff amount. So, always be skeptical about something that sounds like a really good deal. Watch your step.
Hey, can I chime in here real quick, Rick? I'm sorry.
Go ahead.
Yeah, guys, this is what both these guys are saying is completely true, right? And I'm talking from the borrower side. I'm not a lender. I talk to hard money lenders and private lenders a bunch. You have to know your numbers. It has to be real. These guys aren't lending their money out. If you want a good lender, someone's going to be there for you. You need someone that's going to ask you questions and vet the deal themselves for sure. Both of these gentlemen speaking are fantastic and can do that for you. If they tell you no, though, maybe take a second look at the deal and make sure you're communicating correctly and that kind of stuff. But definitely be skeptical of anyone that wants to give you money away for free, basically.
Yeah, I got one more quick story here before I move to the next slide. We have a borrower who's a fantastic borrower. She's does amazing work in this area in Culpeper and Orange County, and just she's all over the place and she's doing amazing work. And when she first came to us, we told her, what our terms were, and she said, well, my current lender gives me 100% financing on all my deals at 10%. And I said, wow, well, you don't need us then, if that's the case. And, I would not lose that lender if that's who you have. And she said, but it seems like it costs me a lot of money at 10%. And I said, well, let me take a look at your promissory note. And a lot of borrowers aren't understanding how lenders are charging them money. And this particular lender was charging 10% on the loan, but he also had a $10,000 origination fee due at closing. And then he had tons of back end fees at the back end of the loan. So up front, he was getting a $10,000 payment at closing for his loan doc originations. And then he had a bunch of back end fees. So when we added up everything, that borrower was paying over 22% annualized interest.
Wow.
On the loans that they were borrowing. Yet they were thinking they were paying 10% and they were happy to get their 100% money on their loans, right? So that's all I'm saying is like, understand the numbers, understand. And if you don't understand it, ask your borrower or ask your lender to explain it. I am happy to go through word for word of our promissory note and our deed of trust and our personal guarantee with every borrower. And I do, I send them all documents before we go to closing. I say, please let me know if you have any questions at all. So we are happy, and we disclose everything up front. That first email I send, the loan commitment lender has our fees in there, and our only fees on the back end, we charge a $300 or $400 document fee. And that depends on the deal again, right? Because some of the loan docs we have to write are kind of, they're long, they're extensive. So it's typically between a $300 and $400 document fee. And we charge a $100 wire fee. And that wire fee covers just us wiring our money to the title company and then receiving our wires back. So at the end of the day, the most fee you're going to get from me is $500. And that's clearly articulated in my loan commitment. And so is the interest we're charging and what you would owe us after a 3-month minimum and how it goes per diem every day. So it's written out black and white. You clearly understand what you'd be paying us. If you don't understand that from your lenders, you need to ask them to really sit down and explain it to you. Okay. I'm going to prepare for closing now. This is what I do, right? I write the promissory note, I write the deed of trust. And if you don't understand what the promissory note deed of trust is, I kind of put it here, right? The promissory note is your promise to pay. The deed of trust is the security instrument that's recorded, right, in the county courthouse or the city. And it's recorded generally with the clerk's office, right? And that's where it is actually the security instrument that attaches that promissory note to the property that we're lending on. And sometimes we attach it to a different property, and I can get to that. But I was having a conversation yesterday with somebody who wanted to do a loan on a property. Actually, they wanted to do a loan on multiple Airbnbs they had to help with, sort of the furnishings and things like that. And what we ended up doing was lending that money out, but we used the security of another property they had that was free and clear. So we wrote our deed to trust against that free and clear property to give us that security that if something were to, if they were not to pay back on that $100,000 at some point, that we were able to come after it, we had security in that paid off property. So there's different ways to structure loans. It doesn't always have to be a deed on the actual property that we're lending against. The personal guarantees, I spoke about this. These are recourse loans. Even though we're lending to a LLC, it becomes a recourse loan when we ask you, the borrower, and your spouse to sign a personal guarantee. And all the partners of the business and the partner spouses. The loan we did, the one I was speaking to that took us 5 days to close, that was 2 business partners and 2 wives that had to all sign those personal guarantees. We work with the title company closely. We ensure that the title's clear, that there's no judgments. If there are judgments, that they're going to be recorded on the HUD-1 to be paid off, that if there's a payoff letter, that's there and that all the judgments are clear. We get the insurance and all the title or termite inspection, all the sort of paperwork, and make sure everything's in line. This typically happens, 48 hours before closing, or maybe better if the title company's on top of it, they're going to let us know when title is clear, or if there's any issues. And then probably 48 hours before closing, 48, 24, we're going to wire all our money to the title company and ensure, I'll make a phone call with the title company the next day and ensure that all our funds are there. and you're going to show up and close. Here's what title company typically does, right? They do title and abstract review. They ensure there's no, liens, judgments, all those issues. I'm not going to speak for a title company. They do a lot of stuff. And but they make our life pretty easy as a lender. They make sure that we're informed the whole way through. I always review a HUD before we go to closing. I always want to see it the day before. Once the title company has that HUD done, I want to make sure that I see the numbers on there, that I can see if there are judgments, what's going to be paid off, what the borrowers bring into the table, all those sort of things I'm going to look at. And we just communicate with all parties, ensure all documents are complete. All right, now we're getting to meat and potatoes. So my loan terms, right? And these are always subject to change. Like I said, every deal is different. Like Chuck said, he did the deal was just 10 points. I completely understand why he did that. It was a 2-month loan. If we're going to put our money out for 2 months, we still have to write the documents. We still have to go through all the processes, and we need to get a return on that money. So I completely understand why Chuck did that. My loan terms, I already mentioned this. I have no upfront fees due at loan commitment or closing. We collect all our interest, points, fees at maturity. So once again, if you're a flipper and you buy that house and you flip it and I've given you money, you do not owe me a penny until you sell that property. At that point, I'm going to collect all my interest, my points, fees. I typically don't charge points. We are looking at it, but I'm typically straight interest and then my $400 to $500 fee on the back end, depending on my document fee and wire fee. Like I said, we do not collect monthly interest only payments. There's not a lot of private lenders that do that. Most private lenders do collect monthly interest payments, just like Chuck said. And I put a big parentheses here. It's always subject to change. And the reason why is because it kind of depends on the market. And if the market starts to slow down, it depends on the borrower a lot. If I've got a brand new borrower, I may ask the brand new borrower to send monthly interest only payments just to keep them focused. But if it's somebody I know and I've done, 40 deals with, I'm probably not going to ask them to provide monthly interest. And I think that's a huge benefit to the flippers. If they don't have to do monthly interest payments to me, it keeps them pretty happy. And they would much rather just pay on the back end. But there's a risk to that. I'm taking more risk to allow that to happen, just like Chuck said. All right, here we go. Principal, interest, the $400 document fee and $100 wire fee. That's pretty much my standard. At
Rick,
the back.
do you have draw fees?
I do not have draw fees. So I can talk about that a little bit when we get there. Interest rate, points, loan length always depend on the deal, the borrower, and the market. I've said this over and over tonight. Everything is looked at independently. There is no standard. We are not like an institutional lender that can just say, okay, we are always lending it 10%, 2 points, and whatever. Every deal is different. We look at them all independently and we make our decisions based on that deal. All right, so here we go. So I think this is the last slide. So you can take a picture of this, or you can write down my number or my email address, whatever you want. This is sort of like an overview of pretty much how I lend. 50 to 70% loan to value. So we will go a little higher on the 70%, but in general, this is a good number to look at. We've provided loans at 50%. We've provided loans at 40%. We've had borrowers bring $150,000 to the closing table. And we've brought 300, so it just depends on the deal. The loan amount can cover most of the purchase price. I talked about this, and 100% of the rehab. We always want some skin in the game. So some sort of down payment the borrower needs to bring. Once you've done a number of deals with us, once you have a relationship with us, all that sort of stuff becomes a little more gray. And based on the deal, we can start moving numbers in different directions. Typically, we're writing our loans at 6 months. We do a 3-month minimum interest. So if you were to borrow money from us and return that money in 2 months, you're still going to pay us 3 months of interest. Excuse me. Chuck had mentioned it before that he did a deal with 10 points, and that's why he did that, because his money was only going to be out for 2 months. If we're going to lend our money and it's going to come back to us quickly, we still need to guarantee that we're going to make a little bit of a return on that money. And the 3 month minimum, you know, when you think of like whatever the interest rate is on a deal, it's usually an annualized interest rate. So let's just say, for instance, it was 12% annualized interest. In 3 months, you're paying 4% on whatever money you've borrowed, right? Because 3 months is a quarter of a year, so you're dividing that 12% by a quarter, and that is what I say, 4% interest, right? Does that make sense to everybody? Hopefully. But so in our promissory note, it will say that, you know, you will pay 3 months minimum interest, and then typically what we do is we go per diem after that. So then we just divide that monthly interest by 365, which is that many days in a year. And we come up with a number of what you would pay interest per day to hold our money. And then whenever you decide to pay back, that's how we calculate the interest payback. It's pretty simple. Now, if you were in a loan that was written for 6 months and you go over that, there's a late fee that's associated with that. There could be default interest if you're not communicating and you have our money and we haven't done a loan modification. You're typically going to be charged a default loan interest, and that's pretty high. You don't want to go down that road. That's all. You start paying a lot of money on somebody else's money at that point. Okay, I think I covered most of this. First position, deed of trust, promissory note, personal guarantees. And at the bottom here, I put credit score. I have never once run a credit score on any borrower. That said, that could change easily as well, especially in this market. If you want to do a BRRRR deal where you want to get bank financing after you fixed up a property, I need to know that you're bankable. I need to know that you can go to a bank and get a loan. And if you've got, you know, a 605 credit score, you're not bankable. So I'm probably not going to put my money in that deal. I need to know that you're bankable. And, you know, I taught a BRRRR class, I don't know, a couple years ago, and I've taught it a few times. And one of the things I've always taught in that class is make sure you're establishing relationships with banks before you purchase a BRRRR property. Like, understand that you are bankable and that you've got a relationship with a bank that's going to refinance you out. Because if you're going to go to a private lender, that's what they're going to ask you. Which bank are you working with? Who's the banker? I need to call them, or have him call me. Or do you have, you know, some documentation showing that you're bankable, that they're going to provide a loan? So those are the questions I'm going to ask you for if you're doing BRRRR deals. Okay, that's what I had for tonight. I'm sorry if I missed the mark, but I was just trying to get across, you know, kind of what we do as private lenders. Chuck, any big major points that you wanted to add on to that I missed?
You nailed it. I could add one particular thing, and that's the critical importance of communication in a couple of different ways. Once you have the loan, keep in touch with your lender. Once some lenders require a weekly report, so to speak. I like to get something monthly. So when you send in your payment, for example, if you have an interest-only payment once a month, send a couple of photographs, send a couple of sentences that's saying, well, we're putting on a drywall goes up next week, inspection was okay. Just keep and communicate with your lender. Another example is if something goes wrong and the contractor problems, or you find the damage in the property you hadn't anticipated, let your lender be your first phone call, not your last. To give you an example, I had a lender I hadn't heard from for a couple of months. I emailed him and said, you know, how's it going with the property? He tells me about a month and a half ago, his contractor ran out on him. So he's kind of patching it together with temporary handymen until he can find a regular contractor. I said, why didn't you call me a month and a half ago? Within a week, I had him a solid contractor who got his project back on track. If he'd have told me that a month and a half ago, because lenders have resources too. We have networks too, and I have contractors, and we got him back in the game. Another incident was I had a request for a loan, so I processed the request and sent some questions back to the borrower, and I didn't hear anything for about a week. So then I followed that up with another email saying, I'm going to pass on this loan since I haven't heard from you. I haven't received the answer to my questions in a week, so I'm going to pass on this loan. And within an hour, he called me. It's too late then. Why didn't he call me within an hour when he got my first email with the questions? Communicate. I don't want to put $100, $200, $300,000 in someone's hand. They communicate with me when they ask for it, and then they don't after they get it. That's a definite no-no. So all through the whole phase of requesting the loan, receiving the loan, and finishing up the project, communicate with your lender.
Amen, Chuck.
Great advice.
Communicate is it's a two-way street. Like I always reach out to my borrowers and say, hey, give me an update. But most of the time now they just do it. And when they stop communicating, that's when we'll reach out and try to remedy a situation. But we have, a lot of our borrowers, even though we write a note for 6 months, if they call us at 5 months and say, hey, we're going to need another month on this note, it's usually not a problem. We'll just go another month on the note. If we have to do a loan mod, so a lot of times some of the money we're lending is like IRA money, individual retirement money, and things like that. So sometimes depending on which funds I'm using, I'll actually do a loan mod. Otherwise, I'll just we'll just do a quick document that shows that we both agree to extend the loan for a month. So it just depends, but if you're communicating with me and it's an understandable reason to extend a month, or even if you need 2 months, we'll do it. We just need to understand why, but don't communicate at the last minute asking for that, because we won't allow that. It needs to be open communication. I had a borrower, I was at Dealmaker, like I said, and a good investor down there that many of us on this call know said to me, hey, do you let somebody come in second position on one of your loans? And I said, no. I said, it even says in my promissory note that, second deed of trust is not allowed. And, as soon as we find out that somebody were to put a second loan on top of ours, that you would go into default. And they asked, well, why would you do that? And because to me, it's a sign of risk, right? And it shows that you're unable to stay within your scope. You're running into liquidity issues. You need to borrow more money to pay your lender. And the reason he asked that question was because he said, well, if I'm having trouble making my monthly payments, I need to borrow more money to make my monthly payments. So now I don't necessarily take monthly payments. So he wasn't necessarily asking for one of my loans, but it sounded like he was asking for somebody else's loan. And I said, well, you need to read that promissory note, because more than likely that lender does not allow a second. And that's the reason why, is because you are now becoming a risk. So Chuck, I don't know if you allow seconds on yours, but we don't.
No.
Yeah.
No.
So hopefully that made sense. Are there any questions from anybody that's still on the call? I don't know how many I've lost over the last hour. Hopefully not too many.
Rick,
There's
Rick,
still
this is
20 people on the call.
What's that?
here's my question. So do you use an attorney at all, or are you doing this all yourself with you just so many loans that you've done?
Yeah, I mean, I have used an attorney to verify our documents, but I don't use them on every deal. If there's something strange, if there's a need to bring an attorney in, we'll absolutely do that. Most promissory notes and deed of trust I draft myself, and I do it using verified documents from an attorney.
Do you have a preferred title company that you like to use you're used to?
No, I mean, we're working with so many different title companies. It really, I let the borrowers generally pick the title company. I don't necessarily care. If they don't have one, I'll certainly suggest one or two or three. But I mean, there's so many great title companies around that, you know, there are probably a handful of 5 or 6 in the Richmond area that seem like we just go back to over and over again, you know. Full
Right.
check, Lafayette title, like, I mean, up here it's United Title, Signature Home Settlements. They're sort of the same ones that just keep coming up over and over again.
In this
Hey,
market
Rick.
go ahead. No, your turn.
Hi, Rick. It's Paul. I'm up here in Northern Virginia. 2 questions for you. Do you do loans up this way? Like Arlington, Alexandria, Annandale?
Yeah, not too much. I would certainly, I would certainly look at a loan up that way. Right now, I don't go much higher than the Dale City area right now.
Okay.
But I would be willing to look at it. I don't do anything in DC right now, and I'm not really interested in working in DC, but I'll stay in Virginia. I'll look at anything in Virginia, really.
Okay. And last question for me. So there's always the question of when you're working with private lenders around using contractors that are in their network versus contractors from outside of their network. Seems that lenders tend to give better rates because it's a lower risk if you use their contractors. Is that your experience?
I will say no, it's not necessarily my experience, but I will say the majority of my borrowers are contractors. Like most of the borrowers that I'm dealing with are either licensed GCs doing the work themselves, or they've got crews that they've had. And I know most of I don't necessarily personally know them, but I know that of the crews that they have, I don't change my terms based on which crew. Chuck, do you do anything like that?
No, because I found that a contractor might have a pretty good reputation, but if you recommend them to someone, they may not be that consistent. So I don't recommend contractors. The one example I used earlier were the borrower had a contractor run out on him, and I supplied another one. That was a contractor who was willing to come in and hit it for a month and finish up. But as far as just appointing contractors or recommending contractors as a general rule, I don't even go there.